There we go. I didn't get my little signal. Good morning, everyone. I'm Dr. Laurie Davis, and you're listening to the Dr. Laurie Davis Show. And I'm so happy to say good morning because we have moved our show time to 11 a.m. Mountain Time. That would be 10 a.m. Pacific Time. And it helps our viewers out east get us at a decent hour as well. So I'm really excited about that. We're beginning season 5. And each day we of the show, we have a featured guest or we interview, but we have a particular topic. And on Tuesdays, we've chosen to talk about finance. That thing that nobody really wants to talk about, money. Two things people don't want to talk about, money and sex, but we'll talk about all of it. So there you go. I'm really happy to welcome Ramin back as my co-host for Tuesdays. Thank you, Ramin, for being here. And you have a little news to share because you've been doing some traveling.
Yes. Well, good morning, everyone. Again, it's a joy to say good morning. So I'm glad I'm here. Yes, I had a wonderful trip to Alberta, Canada, and met wonderful people. Of course, starting with Dr. Laurie, you were so gracious. I really appreciate your, again, wonderfulness, I should say. And yes, it was I would say, very promising. It was a bittersweet trip because I saw the realities of life. We had visitations to some of the places, but also gave me lots of hope on top of that, knowing that we have solutions. The things that we are going to do is going to make a difference. And it gave me that sense of urgency, but also that mission is the possibility of missions. So it's not mission impossible. I would call mission is possible. So, and
Oh,
by the way, how
cool.
do you like my
Oh, oh, your medallion. Isn't that beautiful?
I'm so honored to wear this as a gift. It was given to me, and it looks really good on me, I think. I hope.
Absolutely, it
Yes.
does.
So, yes, that's one of the endearing memories that I have receiving this.
Oh,
So, there we
excellent.
are. Yeah.
Awesome. Yes, we made great strides. We have big projects that we're going to work on, and we'll talk more about that another day. But today, you wanted to tell us about some biases as it relates to finance. And we're probably going to do part 1 today. And when Ramin comes back next week on Tuesday, we'll do part 2 because there are so many of them. And we're just going to banter back and forth with the conversation. So if you're going to be joining us live, we also have the capacity now to take calls. So if you have questions or you want to ask a question or you have a comment, please feel free to call us in at this number. I'll put it up on the ticker. You can dial in at 825-420-2011 and talk to us live. I love that.
Mhm.
So it might take a while for our viewers, Ramin, to get onto that, but it'll happen eventually. And looking forward to that. So let me turn the mic over to you, and just for your introduction and share a little bit about the information you brought to us today, biases in finance. I'm really intrigued. I've got my notepad already.
All right. Wonderful. It's interesting. What we talk these days is about artificial intelligence, how much power it has, the machine learning and what the computers can do, which we are all familiar. And when it comes to investing and let's say money management and trading, obviously the machines do a lot of data analysis and all that. As humans, well, we are not machines. Although our brains have a lot of capacity, we have to put into effect our past experiences, our belief system, all the things that has affected us, environment. And when we think about our approach in life, whether it's relationships, whether it's finances, work, is usually based on fear and hope. We make our decisions based on that. And again, it's based on our experiences that we've had. So when it comes to investing, it plays a huge role, and people do not realize it because they look for the tips. Oh, what is the best stock to buy? What is the best investments? They don't realize how much is inside of them. And whether you're a young person to start with or whether you're a seasoned trader, it has these effects on you. So I thought it would be a timely subject before we learn about all about the technical side of things. We do a little soul searching and look at some of our own biases. So today, what we're gonna look at is there are many of them, and in investment world we call it behavior finance. So it applies to the general population. So I thought let's choose, we'll see how many of them we go through today. uh, these are the things that are common, and most of us are, I don't want to say guilty of, but we have used that in our own decision making. So before I start with that, let me start with a story. I always loved stories. So many of you perhaps know Pele, which has been considered either the greatest or one of the greatest, not only soccer players, but athletes in the world. And so I want to share a story about him and his belief system and how it affects us. In 1960s, he played for his club called Santos in Brazil. And one day, he gave, at the end of the match, he gave his shirt away. And after giving that to a fan, and after giving that out, all of a sudden his performance dipped. He could not score a goal. So he connected giving that shirt away was the cause of his underperformance. So that became a belief for him. So what did he do? He goes, some people say he hired a detective. Some people say he asked his friend to go find that fan and get that shirt back.
Oh,
So a week later, this detective friend comes back with a shirt. Sure. He receives that shirt, and guess what? He starts scoring goals again. And the greatness is come back.
wow.
Well, lo and behold, nobody knew that that shirt was not the real shirt. The detective could not find the fan. So what he did, he went and got the shirt from the previous match and just gave it to him. So in his mind, he thought that he had his old shirt back, but which was not. So this is all about humanity. What we believe in has nothing to do with the substance of the things in the sense of it's given to us. So that's how our biases are built. And a lot of athletes have rituals before the game. They have things that I won't bore you with that. It's like a lot of fascinating stories. So that's how it applies to our decision making when it comes to investment. So I'm going to start with the first, we call it again, a bias or belief that we have when we do, or some of the things that psychologically we do is when it comes to the investing. Number one, which has really lost more money than many people than they can imagine, is called loss aversion, avoiding the loss. So how does that work? As a child, when you come home, do you go to your parents and say, "Oh, look at me, I get an F today," and you get rewarded? Well, most parents, as you know, I mean, just from the school of teachers, expect you to be a top student because that relates to your as a person, how much value you're put on yourself. So as investors, we don't ever want to admit that we are a loser. So I can get into an investment, I can buy a stock, the stock goes down. And I know, the news comes out, they're, let's say, talking about earnings. The stock is not a good investment. But because I don't want to admit that I made a mistake, and again, so-called I'm a loser, I stay in this investment. So let's say we bought the stock, it's down 5%. Well, 5%, let's say I lost $50. I'm just using an example. Well, I don't want to admit that, so I stick around. It goes to $100. It keeps going down. And at that time, I start praying and then saying, God, and that's when we find God or the universe. Please, I will promise. If I break even, so that's the key. Not even the winner. If I break even, I will never make that mistake again. And that actually gives us, from the technical side of things, to know where things are going to happen in the future, because people are always looking to that break even point, and you end up losing 50%, 60%, and yet you're still not willing to accept the loss. Has nothing to do with the mechanics or understanding the investment. It's all about us. So loss aversion is a very impactful um, psychological effect on us. And I have to go even more than that. You stay in a job that you hate because you don't think you should stick around. We stick around in the relationships because we don't want to be the loser or quitter. And it happens again with this. It's just that, again, we've been told by the society you have to be a winner all the time, and that's loss aversion. um, I'll leave it up to you if you have any inputs on that, or my
Well, that's
first.
very, I find, yes, that's very interesting to make that connection to the money because we all have been in situations that we needed to get out of. Like you said, whether it was a job, a marriage, a partnership, and because of the good look thing, that a lot of people rely on that to maintain their self worth or to feel good about themselves. And so to admit that we've made a mistake. Also, I'm thinking as well, uh, when we made mistakes as children, some of us were severely punished.
Yes.
And so there's that trigger perhaps going on for some people. So that's very great. Yeah, I get that one. Okay, next.
All right. Well, let's go to number two. The number two is, we call it confirmation bias. And what confirmation bias means, when we make a decision, we look for the news or the things that confirms our decision. So we filter out anything that it's not to our favor, and we stick to the things. So let's say we're watching, the business or financial news, and out of 10 things, maybe two was in our favor, and we say, "Oh, yeah, I did a good investment decision," and we ignore again the things that they are not supposed to, in our favor. And again, you can see the same thing happens in the relationships, in our businesses, in our work. We always try to find people surrounding us who confirm our own opinions, and we kind of diss people who are not in our side. As a matter of fact, I have to tell you, we always, well, of course, we talk about surround yourself with positive people, and always look for people who can help you. But some of the best lessons I've learned, and again, it's people who are truly mean well, is people who are pessimistic. If whether I'm doing a business venture, or I look for what is the worst case is going to happen, whether I do my trading, whether I do my investing, or whether I'm doing a business. Those people are great analytical. They say, Ramin, if you did this, there are the chances this could happen. They are really good lessons. But when we have confirmation bias, we completely ignore that. We live in a kind of a high clouds, and always thinking that, oh, I made the right decision. It goes back again, being right supposed to be all the time. But that's the second thing. When we're choosing a stock, or we always look for anything that confirms we did the right decision, and ignore the reality a lot of times.
Right. Well, that comes in many packages too, as you said, not just money, but we call it, we're very good at wanting to build a camp. And if something goes south, we want that camp, those people that are in that campground with us, to reassure us because of our own insecurities. And we want to make so like it's if you have a fight with your girlfriend, and all of a sudden that she's starting to tell the story to a whole bunch of people because she wants to build a camp to confirm that she did the right things or whatever. So yeah, wow, that's interesting. Yeah, wow. Oh, I've done that. I've been there. Okay.
But you'll be surprised. It happens a lot in investing, in trading. Again, our mind keeps going, you know. So let's say we have 10 different indicators, right? So, and I know if I'm biased, I'm not in investments, I'm just as a bystander looking at this, say, you know what? Seven of these are telling me this is not a good investment. Right? But when you are in investment, you pick those three, and you say, oh, you know what, those seven, they can come back. They're gonna change.
Oh, yeah.
I believe so. So anyway, so that
Go.
that's very common. So we do that a lot. The third one, what we call representative bias. And what that means is we use our past experiences, and basically I would even say the stereotype. For instance, if you go, when you think of a professor, you have this vision of professor, usually goatee, and he's who knows about the hair and other things, and there maybe gray hair, and so we build these stereotypes. And when it comes to investing, we also do the same things. Give you one example. For instance, we think, oh, this company is really good. Just because a company is a good company, that doesn't mean it's a good investment. It's a good stock. Being a good company is just one factor in this. But because we felt that they take care of, let's say, the customer, which is good, but we don't know what is happening with the financial side of things, and we don't even take that effort to do that. So we immediately represent a good company, good stock, which could be a lot of times doesn't mean the same thing. So we call that representative bias. Again, using our past experiences to make decisions about something which could be true or not, or could be good investments or not. But that's our again the decisions that we make based on that bias.
Yeah, so that would be about making assumptions, assuming certain things without actually having done the research or, um, yeah. Well, we can do that in relationships too, can't we?
Yeah.
I just shared July the 11th. I knew what I was doing 53 years ago today. I was marrying the wrong guy. And, at the time it was the right guy, but looking back, it was not a good match at all because I assumed because of the family that he came from that it would be a great outcome.
Correct.
See, so is that what you're talking about?
So that's an excellent question. Again, we put like the family, or
Yeah.
again, we do that assumption. Other things, like for instance, let's say we go to a coffee shop, we see this young man and sitting and drawing, and we immediately think the way it looks, oh, he's an artist. He cannot be a scientist or like a Wall Street investment banker, for instance. So these are all the assumptions that we make, and we based on decision based on that again experience that we've had in the past. As I said, we do a stereotyping on that. So, but it happens a lot in investing also.
Wow.
Yeah.
Wow. Good one. All right. Next.
So the fourth one is we call it overconfidence bias. And that also, again, it happens not only with just the general public, it happens a lot with the professionals. A lot of times we think we know a lot more than we actually know. So when we get to some kind of investments, we are very assured of that. And we also actually brag about it. And again, it happens in the professionals. We assume our investment advisor obviously knows more than we do. So they're going to make the right decision. Based on that perception, they think, well, I know more than Dr. Laurie knows because she's not in investment. So, but that gives a false sense of security in the sense that they also can have all the other biases and make the wrong decisions. So when we do overconfidence, we have the overconfidence bias, we end up concentrating on like few stocks because we really believe. So what we do not diversify our investments because we think, you know what, Tesla or Google, this is it. I'm gonna triple or quadruple my money. I believe in this, and it's gonna work out. So we ignore that economies go through the cycles, and there's a lot of other forces. So maybe I should have something involved with the commodities, such as precious metals, or just have this what ifs. No, I know. And when you talk to them, they're very adamant. They say, well, I know this is going to happen. Just watch me. 6 months from now, my portfolio is doubled. So basically, based on that, you become a big risk taker. because now you constrain on few. Unfortunately, a lot of times it doesn't work that way. And it also following gurus that also, because that guru is so overconfident and oh, he knows what he's doing. But unfortunately, we're human beings, so we have access to maybe some, we have more information, but um, that creates a very risky portfolio, and you have to be very careful, and a very narrow portfolio. So that's, we call it again, overconfidence bias. So
Hmm. Yeah, that another word for that would be arrogant.
arrogant also,
The
yeah.
arrogance comes with that, that because I've had people tell me that their self-worth was intact and their confidence. And then I'm going, yes, perhaps, but your life isn't reflective of that, or how you're talking doesn't reflect that.
True.
And it's a form of arrogance to have that kind of overconfidence about anything. And they, I know that the more I learn, the more I realize I don't know things,
Yes.
and that I have to learn more. I
Right.
mean, the more I learn, the more I know I have lots to learn. So that closes that door for learning also when people have
Absolutely.
that overconfident attitude that's not real, right?
Absolutely. Right.
Yeah,
Couldn't agree.
cool. All right, excellent. Number 5. I'm
So
writing these down. I think this is going to be interesting.
number 5, we call it paradox of choice. So there have been a lot of studies done, and you would think, all right, as human beings, I mean, the more options we have, the more successful we will be. But there was a study done for people who do their like 401ks, and they're given a lot of choices to choose funds. The more funds were available, there was more anxiety because they have so much and you cannot make a decision. It's the
Oh,
same thing, when you're presented with a lot, your brain doesn't want to make a mistake. And what happens is you, over all of a sudden, rather than uh, making the right choice, you end up just making no choice because there's just too
mhm,
many alternatives. It's almost, again, it comes to the relationships or works, and when you're focused on few, you make a lot better judgments, and that is a paradox. So that's something that happens again, especially in retirement planning, and especially with the retail investors, but also when we have, like, nowadays you have the technology, we have availability of so much information, we have information overload. So what we do, I use this example. It's not my original things. We have, as far as the vast information, like an ocean, we have access to that, but it's only ankle deep. So we have all this, but we only know little about a lot of things. So it's better to know a lot about a few things and be very good at it and have information about other things. And that's what this brings out, because we got all of this, we don't know much about it, and then we end up not making decisions. We postpone those decisions. So let's say our employer says, oh, you have this 40 funds. What are you going to do with it? um, I'll let you know next month or next week, or it ends up a year later, you still haven't done anything. So we call that, again, paradox of choice, because too many. And actually, in marketing, as you know, when you're talking to making appointments, you say, well, is Wednesday afternoon good, or should we meet Thursday evening, for instance? Because when you say, well, what day is good for you, our brain goes, okay, I have this, and it takes like a month to just come up with the day. So people like choices, but they like them limited. So the brain usually works, when you think about social security number, they are in threes. They can memorize that. So anything over 7 is a very difficult choice. So we want to give them very limited choices. So that's how our brain works, and that's why we want to be good at
mhm.
things. So
Yes.
that's called
Um,
paradox.
yeah, and I recently, when we want to transfer that information over to an appointment or doing business, I have an appointment this afternoon. This is potentially a brand new client, And I thought, now what am I going to put in the folder? Well, am I going to put all 800 workshops in that folder and say, which one would you like to take? So I did my folder up just around what we have available for children and youth, because that's where what they want to talk about. So yeah, I understand exactly what you're saying around that. Good points, because this is applicable also for parenting, when you have kids and you need to give them options about, well, we're either going to go here or there. Um, it applies to relationships. It applies to everything, what you're talking about. I didn't know this when we started, that I was going to be getting triggered like so much as it relates to other aspects of our life, not just finance.
Yes.
Cool.
Even the food, sometimes going to a buffet is really good, but sometimes it's like they're overwhelmed. It's like end up eating not much, eat a lot of something, but something like I love shrimp, for instance, shrimp cut. So I know what I'm gonna have, but a lot of times you are not really satisfied because you're just so
Right.
out there. So, all
Cool.
right, that was number 5. So when we think about the next one, is we call it availability bias, and what that means is we look at the things that available to us from the information, and we make our decision based on what we were given. What I mean by that, I give you a simple one, is advertisement. So if I see this fund company keeps telling me, oh, come and invest in this fund or this investment, this stock, automatically assume that's a good thing, because I've become accustomed to hearing the available information. Or our employer, our employment, they tell us, well, you know what, you should do this, and this is going to work for you. So we we basically make the judgment based on what is available to us, rather than us going finding the information and do a little analysis or digging through the things. So basically, it also works with, again, with that uh, we mentioned about the building group, that confirmation too. So we think, oh, because they're saying so, that must be the right thing. So that's why these advertisements are very powerful. And the kids start drinking sodas at a young age, or they watch a specific program. We call it like brainwash, but it is a programming. But it also happens because it's just so much available, and that's what, again, we invest in things that again, we've had access to, and we are told, and we believe that's the right thing, which it's not
Mhm.
necessarily.
Mhm.
That makes sense. Is that
Absolutely, yes. Because the media plays a role there, and the media is very powerful, and people believe what they read, what they see on the internet, what they in all aspects. And it could be complete lies, but we buy in because of the media, uh, playing that role of conditioning us and having us believe certain things. Well, just like the ad, uh, there was an ad one time for shampoo. We don't name brands here, but the whole advertisement was about, you're not sexy if you have dandruff on your shoulders. You're not going to get a date if you have dandruff. And I thought, are they advertising shampoo or is this a dating site? But that whole impact of media can be very dangerous. And then people would run out and buy the shampoo because they might get a date.
exactly?
Right? So it's like a mind game.
Absolutely.
Yeah. Oh, wow. All right.
All right.
Excellent.
So number 7, we call that recency bias. And what does that mean when we talk about recency? Our brain, and as human being, we go to the most recent events that has happened, and we ignore all the past information. So for instance, if there's a crisis or anything that happened just a month ago or 3 months ago, we make all our judgments based on that, and sometimes we go to the extreme. So I give you one example. For instance, when the COVID happened, now we had I'm just talking from the investment side of things. Of course, the markets all collapse, and as a human beings, we didn't want to. We thought, well, this end of the world, and I'm not going to invest. So it at that moment, we just looked at that. We could have looked at the history, gone back the past 100 years. Every time there was an event happening, what happened after? As a matter of fact, I did a class right after when one of my podcasts was actually end of March, April of 2020, and we were looking for. Well, I know like March 18th, I went bargain hunting. March 23rd, actually. I was, this was a great buying opportunity. So I looked at the recent events not as a dilemma. It was based on the history that I had, based on my experiences. I thought this was an opportunity. But us as an investors or as a human being, everything that happened most recent, it affects us the most. I'll give you another example. For instance, people go and buy the winners of the past year, for instance. They look at, oh, this was the number one, again, investments or fund. So they base all their judgment because they've done well in the past few months or past, they must do well in the future. So they put all their effort to go and invest in something like that. They don't look at what has happened in the past 3 years, what has happened in 5 or 10, what has happened in different economic cycles. So you don't make your decision and who has been in charge of that fund or who has been in charge of that company. So there's a lot of different things that, again, we are looking for a lot of times lack of time. Maybe we look for shortcuts. That's why we look for gurus to tell us what to do, rather than, again, the gurus, they cannot take their brain and put it in our head and think like them. We use them as a door opener, but the decisions come from us. And because of that, this is a common thing that it we like to follow other people because we don't want to take the responsibility. So if the things go wrong, we blame them. If the things go right, we take the credit. So it's like a win-win situation. So I pass on the responsibility to someone else. And that's why the newsletters are selling, or the media, the whatever TV, the commercials are coming, but like, oh, follow me and this and that, and they bring these guests because us as humans, we don't want to be accountable for that, because if the things go wrong, it wasn't my fault, it was theirs. That was the government.
Right, right. That reminds me of a story, speaking about, an anniversary or an old anniversary today. But back in the day, like, um, the doorbell rang this one day, and it was a vacuum cleaner salesperson. And it was one of those nice high-end vacuum cleaners. And I was working, I had my own money, I could make those kinds of decisions if I chose. And so I just said to him, no, I'm sorry, I can't talk to you right now because my husband's not home from work yet. And I need him to, he's the guy that writes the checks. Because I didn't want to be accountable if that was not a good purchase or not. So, how many times have we done that? And that comes down to not trusting ourselves, doesn't it?
Absolutely. Absolutely.
The recency. Yeah, I love it. All right, over to you.
All right, so number 8, this is almost like the opposite in this sense. We call it uh, regret, or I call it, actually, it's a snake bite effect. The snake
Okay.
bite, right? So how does that happen? The snake bite is when the things really go badly. So we made an investment, and whatever reason it was, let's say we bought a stock, or we bought it, we were actually in stock market. It affects us so badly that we never go back to it, regardless of what the environment is. So if you go back to Great Depression, many people who went to that, and of course it was 1929, we had the Black Tuesday and the market crash. Even though they were, 30 years later, 40 years later, they never touched stocks. Although they could see that stocks had actually outperformed every other asset. But because of that snake bite effect, they never went back. And it happens I know actually people that I'm very familiar with. Like say we had 1987, we had the Black Monday when we had the crash. Markets dropped 22.3% in one day. Their 401k went down. So immediately they sold it. They said, I will never touch the stock again. Of course, by end of the year, things were coming back and everything, after that, it just took off. This is 40 years later, almost 36 or 36 years later. They still not, they putting their money in a savings account or very conservative places just because at one time they were bitten. So we make generalization based on one experience, and it is also common again, like in the relationships, in the job, that goes back on the stereotyping. So you see how they are connected, just because of one or two bad experiences, or even if somebody looked like something, somebody with beard or a mustache, or maybe he was short or tall or from Middle East or Europe or whatever. We use that, or the best thing I can tell you is in trading, it happens a lot. Is the again one bad experience you had is a dog. As a child, if we have a bad experience because a dog barked at you and it scared you, you're 3 years old or 4 years old, it stays with you rest of your life till you resolve that. Has nothing to do with dogs. Doesn't it was just that one experience. And the same thing, this is again the snake bite effect is okay, we did that stock didn't work or that investment didn't work, but that doesn't mean the whole investment is a bad idea, or at that moment maybe it didn't work, but as it when you look at the long term, it has worked. So
I love that one. I was just going, the light bulbs are going bing, bing, bing. Because in that very first marriage that happened 53 years ago today, and I love to cook, and that's one of my things, and I like to create. I don't use recipes too much. But I decided to make a lemon loaf this one day, lemon bread, like a tea loaf, and it came out like a big piece of rubber. You could bend it, you could throw it against the wall, you could drop it, it bounced. I have never made a lemon loaf since. See? So that's just a domestic example of a snake bite because my husband made fun of it and we couldn't eat it. And it was like, okay, that's it. I'm never doing that again because of the repercussions, right? The
absolutely,
punishment, the punishment. And
absolutely.
we beat ourselves up so, don't we? When we make a mistake.
No,
Yeah.
that is what happened. Like you mentioned, I mean, children, unfortunately, a lot of them go through that. It's that, of course, as children, we want approval. We want our parents' approval, our friends' approval, and we avoid these situations. And it stays with us. And that's, I think, bring it from our childhood to our investment decisions. It goes back to don't want to be a loser, don't want to make a mistake, but also we punish ourselves tremendously. We are not forgiving toward ourselves. And when it comes, I talk to our students, for instance, when it comes to trading, the beauty of the trading is what I tell them, you make a mistake, and that's a discipline, which is very hard for a lot of us to have that discipline. And that's why, the machines are very good at it, right? They don't have any emotions, but we are human beings. So in the trading, even if you miss something or if you lost, as long as you know your limit, you cover your losses. There's always a train coming next day. We always have these opportunities. So this is a continuous journey. So even if you make mistakes today, as long as it was not a big loss, or again, you have to learn your discipline. You have these opportunities in trading. You have 24 hours a day. I can sit here for 24 hours and do something. There's always an opportunity. So if we know that, then it gives us hope. One of the things in trading, immediately when I go in, I know one out of the three trades that I'm going to do is going to be a loser. I've accepted that because that's how markets work. It's a probabilities. There's nothing 100%. But I know two out of the three, based on my technique, they're going to be a winner. So I have a 2-to-1 success ratio. So as long as I know that, I know there's a chance of loss, then I'm good with that. I know I can take that risk. So it has no reflection of my personality, has no reflection of who I am. This
Mhm.
is a business, and that's what investment trading is. So just have to
Cool.
accept that. So,
Well, maybe I'll break down and make a lemon loaf later.
yes, why not? You're amazing. When cook and all creative and all that. So this is a
Yeah,
good
I
time.
just had a bad recipe, maybe.
That's right.
Okay, number 9.
So number 9, we call it affinity or familiarity bias. So what I mean by that, we like to do things that we are comfortable and familiar with. I give you one example. For instance, all right, I'll go to this specific. I don't want to name names. I go to
No,
this
no.
retail store, right? And I like this retail store. I'm familiar with that, so I think, oh, this is a good store. I'm gonna buy stock of this store. A lot of times, it happens that we live in a global world. I mean, it's a global markets. We are very interdependent on each other. Many people, because they're not familiar with international investing, other countries, they and I'm talking about portfolio managers, because they're not familiar with it, they completely avoid it. They're not willing to do some work. Yet they could have a first of all, they can reduce their risk of their portfolio, and they could have a much better return. So I give you one example. Warren Buffett was big advocate of, I only invest in the companies that I know, and it's all US based till late 1990s. Then he found out, boy, there's opportunities out there. He would have never done like a tire company in China, for instance, or an automation in Israel, or a technology. He found out, no, it's not just because I'm not familiar with it doesn't mean I have to avoid it. I learn about it. So generally, we do things that we are comfortable with. It's our comfort zone, and we are familiar, and that doesn't necessarily means that it is the best investment decision or is the best when it comes to investing. We also look at the risk. So basically, that's called affinity or familiarity. And we do that in relationships again, or we have our own little circles. We don't want to go outside the box or open up new network of people, or in sports. It carries on in the different aspects of our lives.
Hmm. Exactly. So we're back to, having the confidence to take some risks,
Hmm.
to learn some new things.
Yes.
And we are by nature lifelong learners. So it's like when you don't want to learn, you have to kind of question what that's about. But familiarity for sure. And it's like, and it's back to that trust thing again. Not understanding. Fear comes from not knowing something or not understanding something. And so we fear it. And therefore, like you said, we avoid it. We pretend it's something else. We're pretty good at that, fantasizing, aren't we? Oh,
We are.
hey.
And I think that's one of the reasons. I know people who don't travel. I mean, that's one of the best reasons to actually to travel the world and see the different cultures and different environments. It doesn't even have to be outside the country. It could be in like United States. We have 50 states, and each one has its own special attributes. And that's why I know people who just stay in their own closed uh, family environment. They don't like to have, they have that comfort, and they think that's the world. So that's why it opens a lot of eyes. The same thing again. This is not just the retail investors are familiar with it. A lot of, as I mentioned, I mean, talking about Warren Buffett, or Investor Business Daily founder, which competed with Wall Street Journal. For the longest time, he said USA is it. And of course, in 1980s, it worked. In 1990, but now it has one of the best international sections in its paper. Awesome information. So we are evolving, we are learning, but that's unfortunately that hinders our choices when it comes to finding opportunities and diversification. So,
Right, right. Awesome. All right. Number 10.
Number 10. So I can continue if you'd like. We can just finish it today. If you, we can.
Yeah, number 10 would be good because we end in 10 minutes and we need to do some wrap ups and make some
Okay, great.
announcements.
So we'll
Okay.
do it
So
number
that'll
10.
go.
So number 10, we call it frame dependence. We put the things in a frame based on our judgment. So let me make it a little easier. For instance, all right, I'm in the investment world, and here is information comes from New York Times, and then there's Wall Street Journal. I said, well, Wall Street Journal is in the business of informing us. What does New York Times know about finance and other things? So immediately we disregard the information that comes from a non-investment business. We're not even willing to evaluate that and specifically go to what we think is the source of it. It could be right, but there are times that it's not because we can get a different perspective
Mhm.
from, again, another view. So we call that frame. We put the things in our own frame and our own perception, and we build the things around that. So it's almost like a judgment call. So that's a bias that it happens again. And whether we seek a doctor's advice or any advice, we already have prejudged that, this person, because let's say graduated from this university, I'm just using that, oh, must be excellent in that, or so and so didn't. Well, we don't put it on based on merits. We basically put it on a frame, and the same thing happens in investments. And that's
Mhm.
that's
Wow. Which might be why one afternoon I fired my lawyer, my accountant, and my banker all in one day because they did not take care of me. And I found that, it was a harsh lesson, but that's where the bottom line happened. And I went, wow, paying you guys like $150, $220 an hour to take care of me. And I'm out on the limb here by myself. I fired all of them one day. I walked into every office and I said, you're done. You will not be serving me at all anymore. So because of the professional titles, uh, I grew up in a generation where your doctor was like God,
correct.
and you believed everything they said to you, and you did because they had the credentials or they had the training or whatever it was. And interestingly enough, the other day I had a doctor's appointment, and she gave me all kinds of options, like maybe we should check for bone density, maybe we should do this, maybe we should do this. But she did say to me, those things are entirely up to you, Laurie. And then when I turned one of the tests down that she wanted me to have, she said, good idea, good decision, because I don't agree with that system either. So it's getting out of the box or getting out of that frame and being collaborative and open-minded, I think is what I'm hearing you say. Mhm. Wow, these are powerful. Which is, if you're just tuning in, I'm Dr. Laurie Davis. This is my guest, my co-host actually on Tuesdays. Every Tuesday at this time, 11 a.m. Mountain Time, we're here. Ramin and I are here to talk about all kinds of things because everything's actually connected. But his area of expertise, of course, is finance. And he has a lot of wonderful, wonderful workshops. As a matter of fact, let me see, where's my little ticker here? Wanting to be mentored in finance. We've developed between the two of us 100 Shades of Prosperity, and that's 100 workshops. And Ramin focuses on the technical, mechanical side of the financial world, and then I integrate it with the soft skills or the soft side, like we're talking about today, really, when you speak about it having to come from within us to make those correct investment decisions. That's powerful. So we've put it all together, and we're going to start up our workshops in September. We already have people interested, and it's an amazing 1 year of mentoring education. So just putting a plug in for us, Ramin, because that's what we're here to do as well. The show, this is our 5th season, and we have also created the capacity for you to call in at 825-420-2011. And when we have a topic of interest to you, and you'd like to speak with our guests, whatever that is, we can make that happen. And if Ramin is someone you'd like to reach out to because you just love him and what he has to say, and I had the pleasure, my family had the pleasure of meeting him this past week, and he stayed with us. And you really get to know people when you live with them, and that's a great process, and to be able to do that and have that connection. So here's how you can reach out to Ramin if you want to have if you have questions or anything like that. And we'll be here next Tuesday, same time, same station, for part two of the biases. I can't wait to hear what they are because my mind is going bing bing each time that you're talking, and the way that you share the stories to help us uneducated in the financial world understand what you're talking about is amazing. And so I want to thank you for that. And nice medallion you're wearing there, a gift from our good friend Diane. And Diane is here now too visiting. So I'm just having like the best summer ever. No wonder I haven't had time to do a show. I haven't had a live show in 2 weeks. So I've been off the track on that. But we're back full force. And tomorrow, Wednesday, is a wellness talk. So over to you, Ramin, for anything else that you'd like to share. We've got about 4 minutes to top off our show here. Thank you for being with us again today. So words of encouragement to people out there who, would love to invest perhaps, but have no idea where to go and how to do that. And they stick with, that's number 9. They go to the bank and they buy a banking product called, in Canada, it's called an RRSP, a registered retirement savings plan. And if, that's because it's familiar. Daddy did it, granddaddy did it, and over to you.
Well, like you correctly mentioned, you can see how connected every aspect of our lives are. So the finances are the byproducts of our past experiences, our belief systems again. And what happens is if we can understand who we are, where are we coming from, and combine that with the technical knowledge, that becomes powerful. And I mentioned last time, and I've had traders who have made tons of money and they have self-sabotaged, just didn't know why my millions are gone, because they didn't feel worthy, they just had all these biases that they didn't realize. And they never took the time to find out why. So they're very good. So the journey is fun. They go there. And because of, we will talk about next week about the other biases, because of what they felt that journey gave them excitement, they forgot what was the purpose of that journey. What was it, what you're going to do when you get to where you want to be. So that's how it happens. So yeah, I think these biases are important because what happens is it gives us the clarity why the mistakes that we made, why, for instance, we are 65 years old, or we had a retirement plan, or we are 50 or 40 or whatever, and we've had this up and down, and we still don't have the financial means that we should have had, or the financial capital we should have had. Well, it's very much dependent on this, and why we overreact to things or don't. I mean, these are all part of that. So it's a very important part of any type of investment process that it's kind of ignored by, you don't hear this much on the media or anything, because it has to be quick and it has to be sexy, sell the products, really.
Right. Okay, well, our time is nearly up. You've been listening to the Dr. Laurie Davis Show today with Ramin Modiri, our financial expert, who shows up every Tuesday to share his information that he's acquired over his years of experience. So thank you, Ramin, for that once again. And you look pretty handsome today with that black shirt and that beautiful medallion you're wearing. Oh, my goodness sakes. All right. And thank you for your visit. My friends and my family were honored to have met you and to be in your presence. And I even reiterated to one guest that I have, you better pay attention. This may be the only time in your whole entire life you would have the privilege of sitting with you one on one to gain some information and knowledge, not about money, but just about life in general. All right. So, same time tomorrow, Wednesday, Wellness on Wednesday. So, we'll talk to you tomorrow. We have some things lined up for a discussion. All right. So, bye for now. We'll wave goodbye and go off the air. And thank you again.
Bye.